we fade into the close again. A difficult start for the markets here as the week gets underway. And we have quite a bit more pitfalls lining up here, with the key question, not surprisingly, are we finally looking at some sort of a lasting break? Are we finally looking at a dial that has really and truly turned from risk on to risk off? And is this now a trend in these markets that has really and truly turned to favor the downside? That's what we are going to see if we can't figure out here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And as ever, we are going to be looking here first and foremost at the price action that has given us some sort of a lead here, if we can discern it from last week, and then see if we can't make some sense out of what is likely to come next. So let's begin here with a look at last week's performance. Not surprisingly, it is a hodgepodge of all kinds of influences. The S&P ends up flat last week, at least when we look at any kind of meaningful reflection. It's very narrowly up or down, whether you look at this futures contract or that. Very narrowly up or down if you look at the cash index or a CFD. But the upshot is we didn't really go anywhere. And that's, of course, after we barnstormed higher at the start of the week around the news that the government shutdown was finally going to be ended because we reached some sort of a deal. Not surprisingly, that ultimately left the markets wanting. NASDAQ actually a little bit worse off, down 0.3%. Yields up across the board, 10-year and the 2-year up by an almost equivalent amount here. So the whole curve kind of shifted slightly by just under 1.5%. Crude oil, a modest rebound, 0.6% after the 2% sell-off in the prior week. Gold manages a rise of 2.1% despite a somewhat soggy showing. It rallied on the deal getting done for the government shutdown, then came back quite a ways. And so as we looked at sort of the net result, we ended up with a 2% gain, but that was ultimately the weaker version of the outcome. We were up earlier by a larger margin before sentiment kind of came unraveled midweek. A little bit stronger for the euro. It's up for a second consecutive week, this time 0.5%. But the yen actually takes a bit of a drubbing here, down 0.7%. That seems to echo what we saw in yields. And really the most obvious, glaring anti-risk signal here, the place with the most ready conviction on the risk-off side, was Bitcoin, which fell 9.3%. And obviously after a week where it was down 5.7%, accelerated down with significant conviction. Now, with this in front of us, we begin this week, and the results are anything but encouraging. Now stocks really do start to build some downward momentum. S&P down 0.8%, NASDAQ down 0.7. This time, yields actually coming in. And interestingly, they're coming in at the long end, whereas at the front end, they're relatively steady, which gives you this sort of dynamic that starts to become familiar around the idea that the market wants its rate cuts, it thinks it's going to get them, But it's coming to terms with the idea that the main reason for this indigestion is indeed that the Fed is not going to go soon enough. So the front end, where near-term policy expectations live, it doesn't really go anywhere. But at the long end, risk aversion is starting to be the more potent force. And expectations for future cuts, as well as just a general appeal for anti-risk assets, that starts to create some demand for long-term U.S. government paper. Crude oil off 0.6%. Gold once again moving with sentiment, off 1.2%. And again, painting this picture of a gold that, forget a safe haven, and it was never really that, but at the very least, not even a counter of alternative store of value, not even a counter to multipolarity risk, not even the beneficiary of a seeming sort of accumulation by global central banks amid all of this uncertainty, something that has been occurring regardless of other kind of more traditional gold factors like the direction of U.S. yields and of the dollar. Gold just becomes another speculative narrative here. Maybe not exactly the same speculative narrative as stocks. Doesn't seem like the kind of market where there's one speculative narrative. There's perhaps 3 or 4 main ones. But nevertheless, a speculative asset and a risk sentiment linked asset. That's what gold seems to be telegraphing here once again, as it did last week. So here we're off 1.2%. The dollar is up once again. Yen continues to suffer. It falls almost 0.5%. The euro off 0.25% just about. Looking a little bit soggy, but ultimately not quite giving up its attempt at a break higher last week. So a little bit tenuous here for the euro, but we don't have it on the chart here. But the Aussie dollar lower, as if to say that those things immediately anchored to risk sentiment, they are showing the dollar to be a haven. So the Canadian dollar sees some outsized losses, as does the Aussie. And that seems to be a pattern that continues. Whereas European currencies, although they are down a little bit here, they hold up a little bit better. Bitcoin, of course, down almost 3%. And once again, doing its risk sentiment on steroids thing. That's its comfortable pocket. And clearly we can see any kind of pretension to it being some sort of digital gold or digital something that isn't traditional risky assets. That's obviously not what it seems to be doing here. It clearly has been the most deliberately potent, the most convincing reflection of risk-off sentiment really over recent weeks. Going all the way back to October 29th, the day the Fed told everybody that their expectations for a December rate cut were wrong. And that, of course, is really the essence of what we're watching here. And if we look at the likelihood for what comes next, not surprisingly, the market still has this architecture that we discussed last week, where we seem to have confusion as the order of the day. So it'd be one thing if what this market said was we are 70-30 not going to get a rate cut. We are 80-20 not going to get a rate cut. At least the market would have some semblance of conviction. But that is clearly not what's going on here. At almost 50-50, we are looking at a situation here where the market is confused about what the Fed is going to do next. And that is certainly not terribly helpful here to give the markets some confidence about what they ought to be doing next. Now, as far as event risk is concerned, to drive this narrative in the week ahead and sort of to propel what might be going on here, the first thing immediately on the docket is a very busy economic calendar of Fed speakers. And of course, on Wednesday, the main event is going to be minutes from October's meeting where, not surprisingly, we got our cut. But that was, of course, the fateful day that Powell came out after the sit down and scared everybody half to death. Incidentally, that's the state we've been in. What did Powell do? He came out and said, look, I know I come out here every single time and I tell you all that policy is data dependent. It's not on a predetermined course. But let me just say, I'm saying more than that here. A December rate cut is not a foregone conclusion, far from it. And when he said all these things, the likelihood of a cut was in the upper 90s. And obviously, if we look at it here, it has come a good long way from that level of conviction. So, of course, these minutes are going to be a critically important sort of a thing to see what was it that so spooked the Fed. Was it just the government shutdown and the lack of data? Why the loss of conviction? After all, the Fed did begrudgingly signal there would be 3 cuts in September. Now, I say begrudgingly because this was really a forecast arrived at by a hair. This was the first meeting in September that Governor Stephen Miran took part in. And of course, he is sort of famously on loan to the Fed, to put it generously, from the White House, where he is still chairman of the Council of Economic Advisors. And so it's not as if his perspective isn't something that is relatively predictable. He, of course, was going to be very dovish because that is the administration's perspective, and not in small part because he is part of the brain trust at the administration that is telling the president what is the course of action to be looking for. So, not surprising, but that 3-cut forecast that we see there for 2025 from 4.4 down to 3.6 on the median trajectory, that's really skewed by the Stephen Miran dot on the dot plot. The overwhelming majority of policymakers were of the view that 50 basis points is enough cutting for this year. And that's perhaps where we might end up. So maybe Fed policymakers are not so terribly different in their thinking. Obviously, all the comments that we've had from Fed officials have generally fallen within familiar bounds. Governor Miran has been dovish, as is his argument for months now, and other policymakers have been less dovish. And what seems to be the key insight here that we need to arrive at is just how concerned were these Fed officials, just how much fog are they prepared to tolerate, and how much won't they tolerate. And so how likely is a move in December absent the depth of data that they want versus how likely is it that they pause? And that's why these minutes are going to be very critical. But of course, going into it, and I've highlighted the voters here in yellow, those are the people actually voting on policy this year, we are going to have some incremental signals here. We got one from a whole host of policymakers today. We started with Governor Jefferson here. He came out and basically took the more hawkish view today, saying it's still not clear how much data will be ready ahead of the December 10th meeting. Current policy is still somewhat restrictive. The balance of risks has shifted in recent months. We know all of this so far. But what we still see here is that, according to him, we need to proceed slowly. In other words, he might be on the side of a pause here. Then, of course, we got comments from Governor Chris Waller. He's sort of famously wanted a rate cut earlier in the year and was dissenting as recently as July. Today, he again starts to talk up rate cuts. That's not really surprising. And so far, so good. Not really anything here that necessarily changes the landscape, but we have plenty to look at for the remainder of the week to see what all of this might evolve to look like. So there's still plenty to look for as far as these comments, even around the FOMC minutes. Then, of course, we got the special dispensation of an NFP report. That's going to come out on Thursday. This will be a backfill of September's data. Expectation is for a 50K rise, with the unemployment rate stuck at 4.3%. We'll see if we even get the unemployment rate number. The president has intimated maybe we won't get that, as has White House Press Secretary Caroline Leavitt. So unclear what this changes now, because this is relatively stale data, but we will get it, and we'll see if the markets see something that's relatively in line with expectations as making any kind of a difference in the near-term Fed calculus, because the data is so stale, or not. Then on Friday, we are going to get a timely look at global growth dynamics with the latest update of S&P global PMI numbers. And not surprisingly, because the global economy essentially rests on a pillar that is the Eurozone, China, and the U.S., taken together, they account for well over half of global growth. And so as we look at this, then, we might see greatest interest in what the Eurozone has to say, and as well as, of course, the U.S. The expectation for the U.S. is we're going to get a little bit of a move back in the pace of growth, but ultimately that things are going to be relatively even-keeled. Manufacturing only a little cooler, services only a little cooler, and so the overall composite only a little bit cooler. So we'll see to what extent this makes a dent. This, of course, has been continuous data, not subject to the government shutdown. So maybe we'll get a decent lead on Fed policy expectations there. So we can see the U.S. economy has been relatively well anchored here in recent months, looking at this data. Then finally, on the earnings front, of course, the main story is Nvidia. The expectation is that we're going to get a result that is $1.25 per share, and we can see the range for surprises has been kind of roughly between almost 10 and 4%. So that's sort of what we're looking for here, is will Nvidia, at the very sort of least, give us something like a surprise on the upside. And what that would mean relative to how it's been is an EPS of greater than, let's say, $1.38. So a 10% surprise relative to expectations would be $1.37, $1.38 or so. If we can do better than that, then Nvidia looks like an upside surprise, and maybe we get a little bit of a reload on AI optimism that gives this market a little bit of a leg to stand on. But nevertheless, it's important to remember here, since October 29th and onward, what we've seen is the market shrugging off positive earnings results from the tech sector, which on the whole have looked quite good. Here's a summary from FactSet. We can see tech earnings have been growing at 27.3% year on year in the third quarter, relative to about a 13% earnings growth rate for the overall S&P. Now, first of all, that's impressive for the S&P. And second of all, that's doubly impressive for tech. So it's not as though we're getting bad results here on the earnings front. It's not as though upside surprises aren't occurring. It's not as though these are numbers suggesting that something awful is afoot. So the real question with Nvidia is, what do they need to do for anyone to care? Because so far, the market has been shrugging off this kind of data. Moreover, if we get a soft S&P result, S&P PMI result, or we get a soft NFP number on September's backdated release, what does that mean for Fed policy expectations when we are already looking at 66 basis points on the menu for next year against just 25 basis points that the Fed itself has forecasted? We're already looking at something much more dovish here. So what would we need to see for the market to give this some positive credence? Probably we would need to see something either so god-awful on the data that December would be forced back onto the books by default, or something so incredibly robust that skipping December wouldn't look like a bad thing. It would look like the only plausible thing one might do for an economy that's heating up. But of course, as it stands, both of those are inherently unlikely outcomes. Both of those are on the tails of the distribution. So far, the story has been the market doesn't care about relatively chipper tech earnings. The market doesn't care that the US and China have found a way to at least somewhat cool their trade war. The market doesn't care that the government has been reopened. The market wants December's rate cut. And not only is it that it's not sure it's going to get it, it's much more sinister. They don't know what they're going to get. And that's an environment that's fueling risk aversion. And so if we look at what's been happening here, here's been these rate cuts. And we can see that since the last one, this is October the 29th, when the Fed makes its stand and Powell comes out and says all those things that he said to beat back December rate cut expectations, stocks have stopped rallying since then and have been basically stuck. The dollar has attempted to rally since then. It's been a little bit soggier lately as that sort of resilience in the euro and the pound have suddenly emerged over the past week, but the general trajectory really since the lows in mid-September has been higher. And so perhaps the dollar is just early and has been more so willing to digest in recent days, and maybe this rebound is just getting going. With that in mind, the exposure that I have on here is kind of two minds now. I'm still a little bit long gold. I don't think it finally crossed any Rubicons today, though it really tried. And so I'm still holding out for maybe we bottom right around here. I'm not really risking a terrible amount here because I'm long from levels that are only a touch higher than where we settle today. So I'm standing aside and letting this have some air to figure its way. I am now short the Aussie, even though I am long still from last week, the pound and the euro, which aren't really making much upside progress since I got long. So my leash on these things is very short, and I'm going to be watching very closely, and I'm going to stand ready to flip them the other way. But I still have exposure short the yen on the spot side of things, and I still have, well, now I have this short Aussie exposure, all of them kind of reflections of a dollar that isn't one-sided and isn't uniformly weak. Still short Bitcoin. That's been working, and I've added a little bit more duration here. I've layered into this position a bit. I am now short not just the S&P through these put verticals, but as of today, I've also put on a put vertical in the Russell through IWM. 60 days on this, so giving myself lots and lots of time for this thing and diluting exposure to Delta as much as is reasonable to see this develop lower, hopefully without too much upfront exposure to Delta and too much upfront exposure to a bounce in the event that things get a little bit feisty here before Wednesday's big event risk with the FOMC minutes and Nvidia. And still long the bonds. I've added a little bit of duration here. I had one that was expiring within just 7 days as of the end of last week. I extended duration on that out to 60 days. Took a little bit of a loss there of less than 1% of equity. And still short oil, which is begrudgingly trying to grind downward, so I still have my put verticals there. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things might go therefrom. Also writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.